Welcome to the Grow Your Business and Grow Your Wealth podcast with Gary Heldt. Gary is an expert in helping business owners put together a plan that will provide a better future for their businesses, themselves, and their families. On the podcast, Gary interviews other professionals who share his vision, and together they share secrets and strategies any business owner can use to build a better financial foundation for your business and your life.
Hey, welcome back to the podcast. This week, my guest is Ryan Zabrowski, and he is the Director of Investment Committee at Krilogy. Welcome, Ryan.
Thanks so much for having me, Gary. I appreciate it.
Hey, Ryan, tell us Krilogy. Where's the origin of that? What does it mean?
It is a company that was founded in 2009 by the founder's name is Ken Scornia, a good friend of mine. Krill means the art of accomplishment. So at our company, we are trying to accomplish our clients' financial goals, help them understand the steps that they need to take and decisions that they need to make to maximize the probability of them achieving their financial goals.
You currently have written a book and published a book on investing. What was your inspiration behind that?
So I've read several books. I've read over 1,000 books. And my mentor is Warren Buffett. And Warren Buffett's, yes, his mentor was Benjamin Graham. So Benjamin Graham passed on all of his knowledge to Warren, and Warren's been very gracious, passing all of his knowledge on to us as investors in his annual report. I just felt an obligation to pass it on to the next generation. So when I was writing this book, the person that helped me write it was constantly trying to ask me who the target audience was. And he would say, is it high net worth investors or is it this category? And I said, it's to my grandchildren that want to be in finance. So I really tried to write a book that the principles in there have worked in capitalism. They will continue to work for a century plus to come.
Now, as business owners, how can they apply these theories that you talk about in the book to their business?
When you start a business, that is an action. The risk that you take when you start that business is different based on the operating environment. And this is basically the first 100 pages of the book. So in every competition in the world, the same action has a different amount of risk depending on the operating environment. So the example that I use is if you're walking down a flight of stairs, or if you're walking down that exact same flight of stairs, but those stairs are covered in ice, you're going to take a very different approach because the risk of walking down those stairs is different. You could apply it to driving. You drive differently in a school zone versus a freeway at 5 o'clock in the morning. We constantly take different amounts of risk, but the action is the same. So when we're thinking about starting a business, you need to be very thoughtful about the timing of starting the business. What is the operating environment that you're starting that business in?
Besides timing being wrong for somebody to start their business, what are some of the other common mistakes that you're seeing business owners make, and how can they help avoid them?
Whenever you're buying a business or starting a business, a common mistake that investors make is overestimating cash flow. Business owners, by definition, are optimistic people. So the failure rate on a business is high, and everybody knows that. So if you're going to start a business, by definition, you have a degree of optimism or potentially arrogance. They're generally confident and optimistic about their business's success, or they wouldn't do it. Quite often, we do the same thing in portfolio management. When we buy a business, we need to be very realistic about the cash flows that business is going to generate and the cost associated with running that business. What Buffett teaches us is to create a scenario where you would look at different scenarios and apply a probability to those scenarios and then calculate a median expectation. What you want to make sure under the negative scenarios that you would have sufficient either money on hand capital, or you would have access to capital if you would make a poor decision and start it at the wrong time, or you would be unlucky and have something like COVID happen right before you started your business.
Change gears a little bit here. If you were talking with someone who's getting ready to come out of high school and they're thinking that they want to get started in the business world, what advice would you have for them?
You have to learn the language of the business world. When you go and you speak to bankers to get financing, when you go and speak to investors to help fund your company, or you're looking at balancing your own books, balancing your checkbook, you have to understand the language of the business world. And in our industry, we call that accounting. So you need to, and it's not fun, you have to understand kind of the blocking and tackling, to use a football analogy, before you can win a Super Bowl. You have to get the basics of being a business owner correct, and that's understanding the language. Now, here's the great thing. You don't have to go to Harvard to learn accounting. You can learn accounting at your local community. The book they use at that community college for accounting is the same book that they use at top universities. So basically, you just have to get obsessed with learning accounting, and then you're going to be much better prepared to have conversations with people that are interested in supporting you financially as you go on your business journey.
Now, I know that accounting is a dying breed, and there seems to be more and more accountants are retiring now. The baby boomers and stuff are retiring. So there's definitely going to be a shortage of accountants in the world, for sure. At Krilogy, for your young people that are working, how do you guys help mentor them and get them, if they don't have that accounting background, how do you help get them to the point where they do understand it more and are able to talk with people?
I think that we're a bit in the hand-holding culture, and what we need to explain to young professionals is they have to take some responsibility, or the majority of the responsibility, for their professional growth. And you can give them the path, but they have to be committed to achieving their own professional goals. And those goals, especially the ones that are associated with large amounts of income, those goals are very hard to achieve, and they take sacrifice, commitment, and hard work. So when I talk to, what do they say about Tom Brady? He was first in, he was last out.
Right.
And when I talk to the young professionals, I explain to them, as an older professional now, how I did. And I was in the Marine Corps, but then I was in Wall Street for all those years. It was a requirement that they would make us work long, long hours. It wasn't an option. To keep your job, you had to do it. That culture has changed because of litigation that was waged against Wall Street firms where they weren't compensating people for overtime. So that was a major inflection point in the financial services industry. It seemed like a good thing for young professionals, but it was actually a disservice for young professionals, because you're competing against international hungry students, that you're competing with people that have 20 plus years more experience than you. You have to show that you have this willingness and this fire in the belly to really be great at the profession. And that requires, when you come into the office, you should turn the lights on, and you should be the first car on the parking lot. And when you leave the office, you should be turning the lights off. I always say you need to be on a first name basis with the custodial crew, which I have been my entire career. So I think that if you want to be a great 3-point shooter, you have to shoot 100,000 3-pointers. It just takes a lot of dedication, sacrifice, and commitment. And a good place to get obsessed is get obsessed with the language of the business and get obsessed with accounting.
Right. Now, at Krilogy, you guys, when you're meeting with clients and stuff, in your reports that you give them and trying to help them understand things and what your guys' philosophy is, can you talk about that a little bit?
In the Marine Corps, we had a saying, it was called knowledge is power. And what we try to do is empower our clients to deeply understand their own financial situation. And you would think that they've been living their financial situation their whole lives, so they deeply understand it. And we know that's not true. And we could look at other service providers that I pay in my life. I go to a doctor, but I don't necessarily deeply understand how to read the blood results on my blood test. And I always forget what the cholesterol acronyms stand for and things like that. What we do is we spend the time with them where most financial advisory teams, they might service a huge number of clients, so they have limited time to spend with people. We take a higher client to financial planner ratio at our practice. So our financial planners can really spend deep time with the clients, making sure that we give them reports that are understandable. At the Wall Street firms, you might get an 80-page performance report. You don't need an 80-page performance report. You could get a 5-page performance report that tells you everything that you need to know what's happening with your money. Financial plan, you don't need a 200-page financial plan. Our financial plan is 16 pages. And the financial plan documents and performance documents are the exact same basically for every client. So when we're talking to them, we know exactly what's on those reports because the reports are the same. The only thing that changes is the numbers and the goals.
Right.
The clients and customers start to get empowered because they start to really understand the micro steps that they need to take, the small decisions that they need to take. And then they understand, if I take these small steps, this is where I'm going to land. And this is how long it's going to take me to achieve these financial goals. One thing that we do for people before they retire is instead of us explaining the reports to them, we give them the reports and we have them explain the reports to us. Because if you can teach it, then you really understand it. And it also gives them the confidence then when they introduce us to their friends and family members and the people they care about, they really can give us a recommendation for our services with a high level of confidence.
Oh, yeah.
I can't tell you how many times I've met with people over the last 20 plus years, and they said, I just met with my financial advisor. I had no idea what he was talking about. He completely talked over my head. And that's a bit of an insecurity part on the financial advisor's part, where they try to present themselves as more intelligent than what they really are. And then I also have heard so many times in the past, like we had one client that lost, now this is in the Great Recession. I think the number was $5 million that they lost in the Great Recession, and they didn't receive a phone call. So you want to make sure that you're partnering with a team that has a systematic process in place, kind of if you would go get surgery. You want to have a system in place. We know when clients are concerned, and we know, like right now would be an example, and we can just look at the data and we can see that people are concerned right now because there's change and uncertainty, and change and uncertainty increases fear levels. You want to make sure that you're working with a team that is going to proactively contact you. And it's not on you to contact them saying, hey, I'm really nervous. I need to set up a meeting. I want to take a fresh look at my financial plan and my risk tolerance to make sure that I'm on track. So those are the type of things that you should expect working with a really top-notch financial planning organization. Also, there should be a relationship with the tax preparer and a relationship with the estate planning attorney. So at our firm, we actually have those services in-house, but most firms don't. And before we had those, we just had relationships with all of their estate attorneys, and we had relationships with all of their CPAs on a first name basis. And you don't receive any compensation from those relationships. We just invest in those relationships just to make sure that there's coordination with what their needs of their estate are, what their needs to, minimize tax liability every single year with maximizing after-tax expected returns.
Yeah, I think to me, that is so important. And I preach it all the time because there's nothing worse than those three people are working in a vacuum and don't talk to each other, because something that I do as a tax professional can adversely affect you as the advisor if I'm not giving you the proper information and vice versa. I have seen that quite often.
Gary, let me tell you a story about, to your point, how important it is for all three of the advisors to be speaking to one another. We have business owners, and what we do with them is we will do a forecast on what the value of their business is going to be in the future. And there's some businesses that will never be exposed to estate tax, but there's other businesses that have extremely high growth potential. And what we would do in that situation is meet with an estate attorney and say, if we retitle how this business is owned, we could get that appreciation out of your estate. And then when you die and you say have 40-50 million dollars, you're not going to lose half of your money to the government in estate tax. And it sounds complicated, but it's literally about an hour meeting with an estate attorney, and it's about a 30-minute meeting of signing documents and just kind of asking questions and thinking it through. And let me give you a real world example of how financial planning, when starting a business, can be a very long-term profitable decision. So when you start a business, quite often the value is rather low because it's oftentimes just valued on the cash of the business. But what we do with our clients is we do a business forecast. So we do a valuation forecast for them. And if that forecast would result in them paying a very high amount of estate tax at the time of their death, there's very simple estate planning things that we can do today to shift some of those assets at a very low cost out of their taxable estate and move it into, so they would avoid that estate tax. And we just did this for another client that was selling his business. Now, this family is very charitably inclined. So when they sold their business, they had to realize a large amount of capital tax on their business. So what we did is we did an analysis with their CPA, and we looked at 3 different alternatives for them to potentially give to a donor advised fund, or there's this thing called a charitable remainder trust, and there's another type of trust called a charitable lead trust. So what we did is we created a strategy for the client that advisors and everybody's on the same page.
Yeah, I think that's something really is important. Lots of time I know where I've seen the business owners are coming to us last minute saying, okay, I'm ready to get out. We always try to have that conversation ahead of time because there are planning tools that we can all use to help avoid or at least help mitigate some of the tax effect that's going to happen, because there are other strategies out there. If somebody is now looking to start investing, or they're not happy with who they currently have because they just don't feel that they have that relationship, what are your top 2 questions that somebody should ask a potential financial advisor when they're searching for someone?
This is a major tenet in the book. And There's a question that you have to ask yourself before you even meet with a financial advisor, because that's going to help you choose your path. Do you want to always take the exact same amount of risk in your portfolio, regardless of what's going on in the operating environment? Or do you want to take more risk in your portfolio when there's more opportunity, and when the probability of a substantial market decline is high, do you want to take less risk? So that's really the fork in the road. And basically, people are about 50-50 on this. So if the first answer is, I always want to take the same amount of risk, I'm a moderate investor and I always am going to be a moderate investor, I always have been a moderate investor, and when the market goes down 20%, that's fine. I just rebalance my portfolio and I stick to that moderate allocation. There is no need to pay a financial advisor 1 to 2% to do that for you. There are very low cost alternatives for people out there. Companies like, I'm biased because all of our assets are custodied at Schwab. When I moved my assets, I said, where do I want to have my assets for the rest of my life? And the answer to that was Schwab. But there's other really good companies out there, Vanguard, Fidelity, things like that. If you are focused on staying risk neutral, what we would call risk neutral, the number one criteria that you should focus on is cost of portfolio management. And you should try to get that cost of portfolio management as low as possible. Because if you think about it, if you're just having a neutral portfolio that never changes, you're constantly going to underperform by the fee that financial advisor is charging you. So if you make 6%, you're always going to make 5 because you're paying 1. Now, depending on the size of your net worth, you would most likely be better off in the complication in your financial plan. You could be better off hiring a certified financial planner to help you on the financial planning side on an hourly basis or a fixed fee basis. Okay. So that's a big part of the book. I write this entire chapter where I take this neutral position on passive versus active management. And in portfolio management, we call this decision passive versus active. And if you choose the passive path, there is definite benefits with that. But if you choose the passive path, you really want to be cost focused. Now, I will encourage you, if you're very high net worth, to not choose the passive path, because we lose out on this enormous benefit called tax loss harvesting.
Right.
And we are actively tax loss harvesting our clients' portfolios continuously. The amount of net worth that you can add, not performance, because tax loss harvesting doesn't show up on a performance report. Tax loss harvesting shows up on the statement of net worth. The amount of annual net worth that you can add on your investment assets is 1 to 2% per year if you have an aggressive and well thought out tax loss harvesting program. If you have all your money invested into funds, that is challenging. You want to maximize the benefit of tax loss harvesting by owning individual securities. So if you had a choice between owning all 500 companies, the biggest 500 companies in the United States, in one fund, or if you own them individually, if you tax loss harvested the individual ones, you're going to have substantially more net worth in the future. Passive is good for IRAs, for unchanging. Passive is good for lower net worth with taxable assets. But once you get to higher net worth, you really need to incorporate tax loss harvesting at a minimum, even if you want an unchanging risk amount. So if you say, no, I don't wear sunscreen every day, right? So I only wear sunscreen when the risk of getting sun poisoning is high. That's the approach that I prefer with my own money. And that's the approach that we use, where I say, okay, if there's a business that's worth $1 million and that business is $800,000 because of a market decline, I want to be more aggressive owning a higher percentage of that business. So what you have to do is you have to say, a financial advisor says, oh yeah, we do active management. Then my next statement would say, prove it. Prove to me with your real clients that you have been managing, show me audited, the acronym is GIPS performance reports, global investment performance standards, GIPS. It's the gold standard in our industry of performance verification. Show me that your clients have actually done very well compared to benchmarks. And then what's going to happen is your list of financial advisors is going to go from 100 down to 5, because it's very hard to outperform benchmarks above the fees that they charge, and make sure that they're showing you net performance.
Okay.
So then with that subset, then you have to say, is that performance repeatable? So this is David Swenson, the portfolio manager of Yale, taught us how to do this. He says, from those subset of financial advisors, do you have a repeatable process in place that's going to allow you to have good performance actively managed in the future? They're all going to say, financial advisors are going to say that they performed well. And the game that is highly unethical, but it's done on Wall Street. I write an entire chapter called Pigs on Wall Street. But this is one of the things that financial advisors do. They say, oh, you're interested in performance. Let me find a fund that's performed very well, and I'll sell you that fund. But what you need to see is that all of their clients that they have been advising have actually been invested in that fund. The first question is, do I want to take this am I high net worth? Do I want to take this passive approach versus a take advantage of opportunity, protect my assets in a bear market approach? That's the two different things. And then you say, I want to demand from the person that is telling me that they're great at investing, I want them to prove it. And if you would think about it, who would hire a coach to coach a professional organization where you can't see his resume and you can't see his actual win-loss record? That's what we're looking to see. We're looking to see the financial advisor's win-loss record, and that's GIPS, GIPS.
Gotcha. Ryan, we've covered a lot of good stuff. I think that the listeners have definitely gotten a lot out of this. What have I not asked you wish I had?
Maybe a question for you, and this is something that we spend our lives trying to add value. So maybe I can add value to your listeners. The number of business owners that I have met with over the years, it's stunning. And I do not sell insurance. I am not an insurance licensed professional. So this isn't a plug. You got to be very careful with those people.
Yeah.
Be very careful with insurance people, okay? Because they are motivated for their own personal profit, and most of them they're not obedient to the financial fiduciary duty, okay? So you got to be very careful with insurance professionals. But insurance can really protect your family and really protect your customers of your business.
Right.
So the number of business owners that we've met with over the years that do not have a buy-sell agreement in place to protect their family, God forbid if something happens to them and they die prematurely. And you also need to protect your customers.
Right.
So the example of a buy-sell agreement is we have two business owners. They went to college together. They started a business out of college. They both have families, and they have this agreement. Hey, if anything happens to me, I'll take care of your family. That's best case scenario. But what you can do is you can meet with an estate attorney and you can get something called a buy-sell agreement set up. And that will allow instructions on what will happen to your business if something happens to you. And quite often in a buy-sell agreement, they'll have a life insurance policy. Now, with the taxes, it's different how it's taxed, who owns the policy and all that. We won't get into the minutia there. But if you own a life insurance policy, so back to that example, let's say that business is worth $10 million, and that what you would want to do is each partner would have a $5 million life insurance policy on the other partner's life. And in the buy-sell agreement, then that spouse would receive that 5 million, and the surviving business owner would then run the business. So there would be no interruption in the operations of the business. The other thing that we see with business owners is the number of business owners that do not have a disability policy. A disability policy to most small business owners who have their sweating in that business every day, and they're running that business, and that business feeds their family. If they get disabled because of something completely out of their control, that would be financially devastating for their family. So that's the other thing that I think it would be good for your listeners, business owner listeners, to take a fresh look at. Outlier scenarios. God forbid, I think I'm going to live forever. I'm bulletproof. I'm this business owner. But the reality is, as a business owner, you're working harder. You got higher levels of stress. Your probability of premature death just by the choices that you made as being a business owner are probably higher. So that's the one thing I think we can wrap up here on.
Your book, A Time Ahead, The Investor's Guide to Prosperity and Impact. If people want to read, they want to learn more, where can they find this?
Amazon, and we have a book website online where I publish articles. I've never been on social media, but part of writing a book is they told me I needed to be on social media. So now somebody helps me with this, but apparently we're all over social media. So if you just Google and search for the name of the book, Time Ahead, or my name, or the name of the portfolios that I manage is Equity Tree, you look up any of those, you can find me.
Great. Ryan, really appreciate your time today. I think that our listeners have gotten a lot out of this, and I certainly appreciate the book and look forward to talking to you again here in the future.
Thank you so much, Gary. I would love to come back.
Ryan, again, thank you for your time today. Really appreciate it. Our guest this week was Ryan Zabrowski, and he is a director on the investment committee at Krilogy, and I'll see you guys next week.
49 faces looked to him in triumph. Over the last 12 months, they had each taken turns and promoted his business for a week at a time, driving over $987,342 in revenue. What if you had a network of 50 centers of influence who promoted your business every week for a year? Grab your copy of the #1 Amazon best-selling book, The Ultimate Guide to Growing Your Business with a Podcast, at 33% off the Amazon price by going to ultimatepodcastbook.com. Again, that website for 33% off the Amazon price is ultimatepodcastbook.com.